Good morning from Tokyo. My name is Agnes Suri. I'm the Deputy Head of the Capacity Building and Training Department of the Asian Development Bank Institute, ADBI. Welcome to the fifth episode of our webinar series on the economics of climate change. With 1 hour webinars, this series is meant to provide initial knowledge on key issues. It is based on the idea that climate change and the required transition to respond to it adversely affect economies and public finances through diverse transmission channels. In addition, countries have a range of financial instruments and economic tools to respond to the climate emergency. And here I'm referring to fiscal policies, budgeting, debt management, financial regulatory frameworks, and so on. These instruments play an important role in promoting climate adaptation, reducing greenhouse gas emissions, and supporting more sustainable and resilient growth. With this knowledge product, we hope to improve general understanding of the economic and financial aspects of climate change, recommend economic financial solutions useful for policymakers to build resilient and low-carbon economies, and we hope to strengthen developing countries' capacities to design climate strategies and align these with national budget processes and investment plans. This fifth episode is entitled Putting Corporate Climate Disclosure at the Center of National Climate Strategies to Scale Up Private Climate Finance. Let me now invite the ADB Institute CEO and Dean Tetsushi Sonobe to welcome you and introduce the theme of this episode. Dean Sonobe, the floor is yours.
Thank you, Agnes. Good morning, everyone. Welcome to the economics of climate change. Today, our topic is corporate climate disclosure. So about this, some people say that private corporations are reluctant to invest in green technology development, reduce carbon emissions from the supply chains, or financially contribute to resilient infrastructure development for climate change adaptation. But this is not always true. They could be eager to contribute to climate finance and action under some conditions. Private corporations would be happy to contribute if doing so were appreciated by societies, especially by their customers, leading to greater profits, or by their shareholders, leading to lower capital cost. In reality, however, it's not easy to get the climate action and finance appreciated by those shareholders and the customers. Why is it difficult? There are two possible reasons. First, it is not easy to show clear evidence. Second, many other corporations, without making any effort, could pretend that they were also making great effort and meaningful effort. It is impossible for customers and shareholders to distinguish corporations that are making real efforts from those not making efforts. Hence, no appreciation and no profits from climate action and finance for private sector corporations. To change the world, two things would be important. First, make it easier to show clear evidence by making straightforward standards and formats for corporations to disclose relevant information. And second, adequately guide and regulate so that corporations comply with such standards and formats. Of course, these two are easy to say, but difficult to achieve for many reasons. For example, technologies are always changing and situations vary from country to country, sector to sector, and from product to product. So we need to discuss a lot and learn a lot about corporate climate disclosure. So today, we are delighted to welcome excellent speakers, Professor Sayuri Shirai of Keio University and ADBI, Mr. Linfen Chen of EcoVadis, and Ms. Nadia Zainuddin of Securities Commission Malaysia. Thank you very much, Shirai Sensei, Linfen, and Nadia for taking the time to join us. So we look forward to your great discussion. I stop here. Over to Agnes.
Thank you, Dean Sonobe. So as you said, let's start with the presentations. I would like to invite first Sayuri Shirai, who is, as you said, advisor for sustainable policies at the ADB Institute and also professor of economics at Keio University. So I would like to invite you, Sayuri, to make your presentation. You will further explain why climate-related information disclosure is so important to address climate change. And you will also introduce the key concept of climate disclosure and existing international standards. So Sayuri, the floor is yours.
Yes, I hope you can see my presentation file. So we are organizing a climate finance dialogue at ADBI, and we put a lot of emphasis on disclosure. So today I will briefly explain about what's going on in this area. So first, why corporate disclosure is so important? Because with a better disclosure, it enables companies to incorporate climate-related risk and opportunity into their risk management, strategy, and actionable planning and decision-making processes. And also, creditors and investors, they are able to increase their understanding of the financial implication of climate change. As a result, reflecting those risk and opportunity related to climate change, the market are better able to channel the investments to truly sustainable and resilient solution, opportunity, and business model. Now, globally, there is a trend towards standardization. So we have a multiple disclosure standard, more than 12. And then TCFD guideline was developed in 2017 and 2021, but still there are numerous disclosure standards. So because of the investors' concern about the spaghetti ball impact or coming from a multiple disclosure standard, so ISSB was created under IFAS Foundation. So they disclosed the climate-related disclosure in June. So, and this ISSB standard is endorsed by FSB, BCBS, IOSCO, G20. So we expect a lot of countries will make this standard mandate. So the essence of this ISSB standard is based on TCFD recommendation, and then company investors should clarify the physical risk and transition risk. The physical risk, as you know, it's comprised of acute events and chronic shift, such as sea level rise and temperature rise. And then also transition risk is very important. This comes from the changing policy, such as introduction of carbon pricing, new technology, or the sudden consumer and investors' preference may change. So this transition risk is highly closely associated with GHG accounting, GHG emission. And then, of course, there is opportunities so company can gain by taking climate-related action. So nowadays, we know the global standard is the company should disclose climate-related information based on the following four pillars: the governance, strategy, and risk management, and metrics and target. And the strategy is quite important because there the company have to explain how they are going to achieve their GHG emission target and the detailed plan included in a transition plan. And also, companies should show the scenario analysis in order to examine the resilience of their business model against climate change. The metrics and target are quite important because they include this GHG emission target and data. And nowadays, we know not only climate change, but in future, biodiversity and human capital, all those sustainability issues should be disclosed based on these 4 pillars. The most important indicator of this climate change issue is GHG emission. As you know, it's comprised of scope 1, direct emission, scope 2 emission coming from purchased electricity, and crucial, the GHG emission come from scope 3. It comes from companies upstream, like purchases of goods and services, capital goods, materials, and downstream, once the company produce the product, they sell those products to the customers and users. So the company have to calculate all those emissions. There's a lot of challenge related to this scope 3. So still a lot of companies just starting to disclose scope 3 and many difficulties here. I want to mention one issue. There's one challenge related to disclosure. So climate-related disclosure or any sustainability-related disclosure kind of decompose into 2 types. One is so-called single materiality. That is also called financial materiality. This means that companies should disclose the impact of climate risk, for example, on their company's financial performance, like sales and profit. So it's a one-way impact from climate change to companies. This financial materiality is supported by ISSB and also US SEC and California's legislation focused on materiality. However, there is a growing forces and movement supporting double materiality. Double materiality means financial materiality plus impact materiality. So companies should not only disclose the impact of climate change on their financial performance, but also companies have to disclose the impact of their businesses on climate change and sustainability. So externality have to be reflected. And so companies have to get some quantitative data. This is very challenging, but many institutions feel the double materiality disclosure is quite important. For example, EU CSRD, ESRS standard, which just started this year, they focus on double materiality. So as a result, more disclosure and indicator, more disclosure of indicator have to be made under EU CSRD. And also a lot of foreign companies which have a subsidiary in EU or have a trading, exporting relationship with EU, they will be subject to this EU standard. So this is creating a lot of, to be honest, on the companies. And also CDP, quite a well-known NGO that focus on corporate sector disclosure, also focus on the double materiality, and so as a well-known GRI standard. So while ISSB push for double materiality, and 2 years from now, they're going to have a new disclosure on biodiversity and human capital. They always focus on the single materiality. In the meanwhile, there are those EU, CDP, and others focus on double materiality. What does it mean? So it means companies still have to prepare various sets of disclosure. So for example, very big Japanese companies, they have to disclose based on ISSB because Japanese government is going to make it mandatory a few years from now. But also big Japanese companies, they have a relationship with EU. So they have to start to disclose based on EU CSRD, completely different format. And also they have to meet the CDP requirement. And then from 2026, if US SEC regulation is applied, and also California legislation, which requires scope 1, scope 2, scope 3 disclosure, then Japanese company have to also prepare the different set of the disclosure for the US. So standardization is taking place based on the ISSB, but in reality, it's not completely standardized. So company have to prepare various sets of disclosure formats. So this is creating, I think, a lot of burden on the company. I want to know what will happen to this global trend in the future. But this is, I think, one area we really have to discuss very closely. Thank you very much.
Thank you very much, Shirai-sensei, for this first presentation. Indeed, these standards are evolving rapidly, and it is critical to raise awareness on them. In addition, data on greenhouse gas emission is a key part of climate disclosure. And disclosing information on Scope 3 emissions, which are all indirect emissions that occur in the value chain of the reporting company, including both upstream and downstream emissions, is a big challenge for all companies, especially the smallest one. Now we have a good understanding of the basic concepts of climate-related information disclosure by companies. I'm delighted to welcome Lingfeng Deng, who is sustainability analyst at EcoVadis, who is the global leader in the provision of business sustainability ratings. Lingfeng, based on your operational experience, how can companies gradually implement adequate climate information disclosure? And what are the main challenges corporates face in implementing this ambitious agenda? What are the solutions available? Lingfeng, over to you.
Thanks, Agnes. I hope everyone can see the screen okay and hear my voice. Yeah, thank you. Good morning, all the participants. My name is Lingfeng. I'm currently working as a sustainability analyst and carbon specialist at EcoVadis. I'm also a former associate at ADBI, so I'm very happy to be back and speak alongside with our amazing speakers, Shirai-sensei and Nadia. So firstly, I would like to introduce EcoVadis. It is a French-based company and also one of the major sustainability rating providers, specifically focusing on supply chain sustainability. So with other providers assessing the sustainability performance of the company itself, EcoVadis will assess the performance of not just our clients, but also all the supplier companies within their entire supply chains. Our assessment covers 4 major themes: the environment, labor, human rights, and ethics, and sustainable procurement. From this year, the companies can also choose to receive a carbon-only assessment, which is originally part of the environment theme. So today, I will be speaking from the perspective of a sustainability rating provider, mapping some of the recent trends of the sustainability reporting, and explain how can a company cope with the challenges in implementing adequate disclosure, also with a particular focus on climate-related disclosure, and explain what kind of reporting is considered reliable by a rating provider. So since some of the trends already covered, actually already briefly mentioned by Shirai-sensei, so here I will just briefly walk through it. So initially, the climate reporting was voluntary. Now it's becoming mandatory in many places. This change highlights the growing importance of climate-related information for investors. And also the climate reporting requirements are expanding, previously focused on just listed companies, and these obligations are now extended to non-listed companies, covering more sectors and company sizes. So another key evolution is the shift from single to materiality, which was also just mentioned by Shirai-sensei. So initially, reports focus on how ESG issues affected the companies financially. Now there's an increasing emphasis on how the company's activities impact the external environment and the society. The reporting entities must disclose not just the GHG emissions, but also climate-related risks and opportunities. So in Asia Pacific region, one notable trend is the inclusion of Scope 3 emission data, changing from optional to mandatory in the next few years. We are also seeing a growing adoption of the ISSB standards. Economies like Hong Kong, China, Malaysia, Singapore, and Japan are aligning their, or at least propose to align their reporting frameworks with the ISSB standards, showing a commitment to international best practices. And implementing the effective corporate disclosure is challenging for several reasons, particularly regarding the financial and human resources, material risks, and reporting data. Firstly, let's consider the financial and human resources aspects. The small companies and medium companies may often lack the capacity to gather and analyze the necessary data. On the other hand, large companies will face high cost in collecting and verifying data across all the locations and subsidiaries. Additionally, industry practice and cultural differences also play a role. In China, for example, most ESG reporting data is done by the state-owned enterprises and those in the financial and banking sectors, which may not be the case elsewhere. Secondly, it is challenging for some companies to identify the material risks. The different stakeholders, including investors, rating agencies, civil societies, and NGOs, they may have different information needs. This makes it difficult to provide comprehensive disclosure that satisfies everyone. Moreover, the judgment of materiality is often uncertain and inconsistent, complicating the reporting process. Certain ESG data might be easier to collect and disclose, but may not be considered financially material by investors. Lastly, the reporting data issues are a major hurdle. There is often a lack of audited data and the difficulties in tracking the data down the entire supply chain. Additionally, the lack of comparability across different accounting standards and geographic locations, plus the inconsistent use of jargon terminologies could further complicate the effective corporate disclosure. So I would like to put the disclaimer here that these are not all the steps, just the step I consider important and useful for the perspective of a sustainability rating provider. Step one is to identify the material issue and then align with the standards and frameworks and also to collect and consolidate the data and continuous monitoring. The fourth step is to enhance the data reliability, and the last one is to keep track of the policy updates. I will also use the company XYZ as an example on what to do in each step. This is a complete anonymized company with all the simplified indicators, just to better explain the whole scenario. The company is based in Japan, but it has also some operations overseas with several manufacturing sites in China. It has more than 1,000 employees, therefore it is considered a large company. Its main business activities are to develop, produce, and sell electronic components and boards. So performing a materiality assessment involves several key steps to identify and prioritize the most significant ESG issues that impact a company's and its stakeholders. Originally, the sustainability reporting was incorporated as a part of the company's financial reports. Therefore, the only thing to consider is the information needs from the investors. But in recent years, in response to the growing needs from the civil societies, we see more and more standalone sustainability reports. So to carefully identify the material issues related to your business activities and needs from different stakeholders is really crucial. Here, for company XYZ, we identify 5 material issues that the company can report on. For example, the energy consumption, since it has high energy usage and manufacturing processes, and the needs for energy efficient practices. And the waste management, which is to manage the electronic waste and hazardous materials, so as the labor practice, health and safety, and customer satisfaction. Another pre-screening process could be performed on the Scope 3 GHG emission by identifying the relevant category among the 15 categories of the Scope 3 emissions. For a company engaged in the manufacture of electronic components, the relevant category of Scope 3 emission can be extensive. Therefore, we identify 8 categories, including the purchased goods and also the upstream transportations, etc., as we highlighted on the slide. And different jurisdictions may have different ESG reporting requirements, and the companies should also ensure that they comply with all the relevant regulations. But if your countries or regions does not have a designated reporting standards, or your company is not under the requirement of mandatory disclosure, you may choose one or several of the common reporting standards here, the TCFD, the GRI, the SASB, and CDP. So according to the 2023 research done by the Governance and Accountability Institute, among the Russell 1000 company, 78 of them align with the SASB standards and 54% are aligning with the GRI standards. As the ISSB standards are consolidated based on all the other standards here, and started being applied globally, we will expect a growing recognition and use of the ISSB standards from now on. So another benefits of choosing a reporting framework is it will equip the company with more consistent and more comparable data, especially for those with little experience in the ESG data management. Since a designated framework is given, the company can at least have an overall direction of what kind of data to be collected and to avoid missing certain important data at the later stage. For data gathering and consolidation, the companies are suggested to have a clear allocation of responsibility and are also recommended to collect data from all its operational sites. For sustainability rating provider, to what extent their sustainability commitment and efforts have been made to the company's operation is very important. We expect something more than just from the headquarters or one of many manufacturing sites. For the company itself, it is also a good practice to avoid being accused of greenwashing. Also, if possible, the company is highly recommended to track down its supply chain and gather information from its suppliers. Lastly, to validate and analyze the data and to ensure the accuracy and avoid discrepancies. And the most important part here is how to enhance the data reliability. And I think that's the needs from perhaps all the stakeholders. First, let's talk about the granularity. A lot of people still have a misconception that the sustainability reporting is just about reporting certain KPIs. But actually, the investors expect to see how the companies set policies and targets and how they implement them effectively and measure the results. Both qualitative and quantitative data are important. We need multi-year reporting that covers the entire operations, classified by locations and sectors. Some companies might concern about their figures in total carbon emission due to business expansion. They can also provide the carbon intensity figures to offer a more nuanced view of their environmental impacts. Next, let's consider the accounting and calculation standards. In the previous slide, I mentioned about the sustainability reporting standards. And please note that the reporting standard and calculation standard are slightly different because the reporting frameworks give you the direction on how to categorize the data, but the accounting standard here offer a tool to calculate new indicators. For the company XYZ, since the amount of CO2 used to generate per unit of electricity, for example, is different in Japan and China, it may need to adhere to different standards in calculating the emissions for its operations in Japan and China. Finally, the third-party assurance is the key. Having an independent party verify the data adds credibility and trustworthiness to the company's efforts. For the rating agencies, the external assurance statement on ESG data can also boost the confidence level of such data. It shows that the companies is serious about transparency and accuracy in their reporting. So we all know that the concept of ESG has been evolving rapidly, so as the corresponding regulations. For example, in Japan earlier this year, the SSBJ they released 3 exposure drafts closely aligned with the requirement in the ISSB standards with an earliest possible effective date from the fiscal year of 2026. So it's always beneficial for a company to keep track of the policy updates and stay prepared for the next waves of the sustainability reporting. And that's all for my part. Thank you very much.
Thank you very much, Ling Feng. Thank you for sharing all the important steps a company X, Y, and Z has to consider in a very concrete way. Your last point on, of course, the fact that the regulation, the environment is changing rapidly, so continuing to raise awareness about it is critical, and this is what we are trying to do here, of course. But I would say all the stakeholders have to play a role. So it's easy for it may be more easy for big companies to keep track of this evolving regulation. For smaller ones, of course, they need to be supported. So now we have a better understanding of the process companies have to go through and also the associated challenges. Let's focus on an interesting country case study to see how policymakers can support the gradual implementation of an ambitious corporate climate disclosure by companies. So now let me welcome our third panelist, Nadia Zainuddin, who is General Manager and Head of Corporate Governance at the Security Commission, Malaysia. Nadia, under the leadership of the Securities Commission, Malaysia is quite advanced now and already took ambitious steps to create a strong regulation supporting climate-related disclosure by corporates. Could you share with us more information about this journey?
Sure. And thank you very much, Agnes. It is a pleasure for Securities Commission Malaysia to be part of this series. So thank you very much to ADBI for the invitation. Just before we go through the deck, I just wanted to maybe briefly introduce the SC. Securities Commission Malaysia is the capital market regulator in Malaysia. And as part of our function, we also oversee Malaysia's stock exchange, Bursa Malaysia, and Bursa Malaysia operates the listing requirements, which is applicable for all listed companies on Bursa Malaysia. We have two markets, the main market and the ACE market. The ACE market is a sponsor-driven market for growth companies, so it's a bit smaller than the companies that are listed on the main market. And this distinction is important because we do differentiate the sustainability or climate disclosure requirements for our listed companies. Yeah, so if you can move to the next slide. So Malaysia has adopted the SDG goals, the 2030 agenda for sustainable development, as well as the SDG goals. And with that, our government has given very clear policy direction to advance a sustainability agenda. We have several frameworks in place, which you will see reflected in that left illustration on the left part of the slide, the 12 Malaysia Plan, our Economy Madani, the new Industrial Master Plan. All of these are aligned to one goal, which is to make Malaysia more sustainable, our businesses, and to achieve a very just and sustainable transition. So the new Industrial Master Plan 2030, which was launched last year, we communicated our target in this master plan to achieve net zero emissions as early as 2050, and to also, of course, then reduce our GHG emissions intensity across the economy, and also accelerate our national energy mix to have more RE as part of this mix up to 70%. But to do all this and to achieve these targets, we will need about 1.2 to 1.3 trillion ringgit, which is about USD 260 to 280 billion between now and 2050 to help us achieve these goals. So for the financing to happen, capital providers will, of course, require comparable and reliable information related to sustainability, including climate, to help them make these capital allocation decisions. And so if you move back to the left side of the slide, you see at the bottom how sustainability information and data will be a critical foundation for the whole country to achieve these goals. So on the next slide, what you will see here is that the sustainability reporting landscape currently in Malaysia in relation to the requirements. So it is segregated by category of companies. You will see listed companies, the financial institutions, and the small and medium enterprises, because as we mentioned, it requires a whole of nation approach. So each segment of the economy needs to be brought into the process. So for the listed companies, naturally, the reporting requirements for listed companies are more mature, more advanced, and these are put in place through the listing requirements, the Bursa listing requirements. The requirements themselves, I will go through them in a bit of detail in the next slide, but we have had it in place since 2015, and now we are progressively moving to more advanced disclosure standards to meet the capital providers' demand for information, as well as broader stakeholders as well, beyond just capital providers. For financial institutions, our central bank, Bank Negara Malaysia, in its document, the Climate Risk Management and Scenario Analysis, has mandated that financial institutions provide climate-related disclosures that are aligned with the TCFD recommendations starting this year. So for financial year beginning on or after 1st January 2024, they must be TCFD aligned, the climate disclosures by our financial institutions. Together with that, much earlier, the central bank, together with the SC, worked together with the industry to issue the TCFD application guide for Malaysian financial institutions. And that's at the bottom of the financial institution column. And the purpose of this application guide is to help the financial institutions get ready for the reporting that's happening this year. So the capacity building happens earlier before the requirement kicks in, and it does not stop. The capacity building and support measures continues. So for the small and medium enterprises, the Securities Commission Malaysia's affiliate, the Capital Markets Malaysia, CMM, which is responsible for promoting the Malaysian capital market, they developed the Simplified ESG Disclosure Guide for SMEs. And this was issued last year. Now, the key word in this document is simplified. What the guide does is it looks at the different frameworks, whether ones that apply financial materiality or those that are focused on impact reporting, to see what would be most relevant for SMEs in Malaysia, given the fact that they are part of global supply chains and there are also demands from local investors, to identify what would be the most critical at this point for them to address. So they would have the basic disclosure requirements moving to more advanced requirements. So it's tiered so that they can see what would be the progression depending on where they are at in terms of the scale of their business, complexity of the business. At the bottom, you will see a guidance that's more specific for the manufacturing sector companies, because manufacturing is a big sector in Malaysia, and that's a specific guidance for that sector. We move to the next slide. This is where I just want to give you a bit of context on what the current reporting requirements are in Malaysia before we move along to the ISSB standards. Since 2015, there has been this requirements for listed companies in Malaysia. You'll see the specifics listed there from 1 to 7. All listed companies must issue a sustainability statement. And in the sustainability statement, there must be information on governance, who's responsible for sustainability oversight. What is the scope of the statement? Does it cover just the businesses here? Which is it the entire group? Only certain subsidiaries? The materiality assessment, what are the material risks? So the red ones were introduced in 2022. So the red ones just came in 2022, where Bursa Malaysia identified 11 common matters that, irrespective of your materiality assessment, Malaysian listed companies will need to disclose information on this, because they were identified to be critical to the stakeholders that are dealing with Malaysian listed companies. So anti-corruption, supply chain management, waste emissions. And then fourth has been there since 2015. How are these then managed? 5, 6, and 7 were introduced also in 2022. So they were recent enhancements, TCFD aligned disclosures, a specific performance data table that correspond to the 11 common themes, and then a statement of assurance. Let me just take a bit of time to quickly explain statement of assurance. Statement of assurance is where listed companies will have to disclose whether they subject their sustainability information to any form of assurance or not. So assurance itself is not mandatory, but they have to disclose whether they subject it to assurance or not. So that's just to clarify there. You see in brackets the timing of when these are meant to be effective. So for TCFD aligned disclosures, it's for disclosures FYE 31st December 2025 onwards. Actually, sorry, that's a typo there. It's 2025 onwards. So we can move to the next slide. So that's the base that we were working on. That is the sustainability reporting requirement that's applicable now. And more recently, last year, the country set up the Advisory Committee on Sustainability Reporting. This committee was set up with the endorsement of our Ministry of Finance, specifically with the mandate to look at the use of the ISSB standards in Malaysia and the development of a sustainability assurance framework, and then to see what are the enablers or support that will be required to help companies use these standards properly, effectively. So this committee is chaired by the Securities Commission Malaysia, and you see the members listed on the left, and these are the main policy makers, the Audit Oversight Board, the Central Bank, the Companies Commission of Malaysia, the Exchange, and the Financial Reporting Foundation, which oversees the current accounting standard setter in Malaysia. And because the ISSB standards applies the financial materiality and would like to see the impact of climate risk on the financial position of companies, and there is that connection, and therefore the role of the Financial Reporting Foundation there. Next slide, please. This I believe is the final slide. So the ACSR conducted a public consultation on the use of the ISSB standards. Just this February, it was Valentine's Day. We started the consultation and it ended on the 29th of March. This public consultation has closed, and it did receive quite a number of responses from various stakeholders, domestic and international. And the issues that we consulted on were, number one, to recognize the ISSB standards as the baseline standards that Malaysian companies will use to provide sustainability and climate-related disclosures. So this does not then stop them from using any other frameworks in addition to the ISSB standards, for example, to meet a broader set of information required by different stakeholders, for example, impact reporting, etc. In terms of scoping, the approach was to tentatively mandate this for the listed companies first, followed by selected non-listed companies, so not all. The consultation proposed that we target the larger listed companies, and large was by revenue. We use a revenue threshold to determine which are large companies. The adoption is of course meant to be phased approach instead of too aggressive and too early, because we were worried about the ecosystem readiness if we were to do so. So hence you see in terms of implementation timing, you see for listed companies, it's as early as FYE on or after 31st December 2025. But if you recall, the smaller companies, it would be later, potentially 2 years after. And for the non-listed companies, likewise, it's 31st December 2027. Assurance is also on a phased approach, likely 2 years after when the ISSB standards are effective for Malaysia listed companies. So if it's 2025, then 2027 is when likely assurance will kick in. And this is because we also need to provide time for the assurance providers, the ecosystem itself to ready, likewise the companies to also be ready to subject their disclosures to assurance. Of course, this does not negate companies subjecting their disclosures to early assurance because of demand, for example, from investors. Enablers are very important, very critical. So we're looking very carefully at transitional reliefs that we can provide companies as they go through this process. Capacity building and support is very key. And we are looking at setting up a support hub that will help companies through this journey, that will also provide some interpretation guidance, guiding materials, references, and also incentives that would help ease some of the companies in the process of using the ISSB standards. I think generally there is support for the use of the ISSB standards, but we just have to manage between companies' readiness and the investor demand and urgency and need for this information. So all this will derive from, of course, extensive consultation. Just to wrap up, Agnes, I think we were starting off, we already had sustainability reporting in place to maintain Malaysia's competitiveness and the companies and the country as a whole. We will need to ensure that we speak the common language that will be used, which is likely the ISSB standards. And therefore, then we issued the public consultation, and we hope to finalize it in the second half of the year, where we will communicate Malaysia's approach when it comes to the ISSB standards. Thank you.
Thank you very much, Nadia, and especially for finishing on this positive note, because you said that all of this can be a bit painful for companies. It's a huge process, but it also creates opportunities. It's also a way for companies to remain in the business game. So it's very important to highlight this point. And also you presented very clearly how climate disclosure is linked to national objectives to respond to the climate emergency at the beginning of your presentation. And your point on the importance of creating a committee to collectively think about the best process and the best standard through a public consultation is also critical, I believe. With your presentation, we can also clearly see that policymakers have a broad range of instruments to support corporate climate disclosure by all kinds of companies, including SMEs, as you said. And I would say eventually build a network of more climate resilient companies. This is important. So we have now a few minutes left for additional discussion. I would like to start with you, Nadia, actually. I have two follow-up questions for you. You mentioned in your last slide that the enablers, which include capacity building and incentives, are very important. Could you spend a little bit more time and give an example for both, please? And the follow-up question,
Sure.
the second question I have for you is about this gradual approach you presented. And for sure, it seems to be the right path to ensure progress, while also giving enough time to companies to be prepared. What was the main obstacle you faced during the expansion of this roadmap, and how did you overcome it? So the floor is yours.
Great. So on capacity building, maybe if, again, just a bit of a background. So when the 2015 requirement for sustainability reporting was introduced, what we did a few years after was to make it mandatory for the directors of our listed companies to go through an onboarding program that focuses specifically on sustainability. It is already mandatory. All directors already have to go through this onboarding program once they are appointed. But the previous content was, of course, focused on the listing requirements, the Companies Act, directors' duties, etc., and that still runs. But we now introduce a new model focusing exclusively on sustainability so that we can give board that ability to understand sustainability because they will need to address it. But now the capacity building focus where we are at the moment is because they have had sustainability reporting as a practice for a while, and they were reporting, for example, based on the GRI and the TCFD. Part of the capacity building now we're also trying to help them see what are the additional elements right now required for them to now move to adopt S1 and S2. Part of the capacity building. And as you can see now, we are scoping in the larger non-listed companies, and compared to the listed companies, they may have relatively, they will need relatively more support because sustainability reporting was not mandatory for them before, and now it is being made mandatory, and the requirements are for some quite advanced. So hence our focus now is to bridge this next phase for the listed companies, but then onboard the non-listed companies on sustainability reporting. So there's quite a bit of capacity building to do there. This is becoming an inevitable cost of doing business and part of doing business. And cost is something that we don't run away from whenever we have engagements with stakeholders. So at the moment, the Malaysian government has given a tax incentive of about USD 10 million, no, USD 50,000 USD, ringgit Malaysia 50,000, sorry. So it's USD 10,000 for every year of assessment to set off any costs incurred for sustainability reporting. So there's a tax relief for the costs incurred for sustainability reporting. So that's one incentive. But I think there's, of course, requests and recommendations that this be increased just to sort of help ease the burden on the part of companies when it comes to meeting this requirement. So that's a capacity building focus. And that's one example of an incentive that's already in place. And there is some sort of requests or recommendations that be looked at, the incentive for sustainability reporting cost. Your second question on the challenge in terms of adopting a phased approach is definitely that delicate balance between companies' readiness and then the investors or capital providers' urgency in terms of needing this information. And for capital providers or investors, they prefer fuller sets of information without reliefs. However, the companies themselves will probably need a bit more time to be able to prepare this information and make sure that it is at a state where it's reliable and it's comparable. So as policymaker, we will have to try to find this Goldilocks spot where it's just right, you know, where investors have what they need and the preparers have the time they need then to sort of address sort of the more slightly more advanced or granular aspects of the disclosure. So that balancing act, I think, it's not a difficult and impossible one, but it's not easy either.
Yeah, thank you for sharing this. I think it will be very useful for all the policymakers watching this webinar. Now let me turn to Lingfeng. Lingfeng, I heard the word greenwashing during your presentation. Based on your experience, what are the main steps to avoid greenwashing and how can the public sector help?
Thanks for the question, Agnes. Yeah, I think indeed the issue of greenwashing has been drawing quite a lot of the recent regulatory focus. In my opinion, there are two main reasons of greenwashing in the context of sustainability reporting. The first one is that data is misleading. This involves misinterpreting the figures or use the vague languages that could actually create a false impression of the company's environmental responsibility. And the second one is that data is falsified or lack of accuracy. So I think for the companies itself, like there are several strategies like for the corporate to avoid being accused of greenwashing. I think the first one, as I just repeated in my presentation, is that the corporation should ensure that their data is as transparent and detailed and granular as possible. Hiding the figures or presenting them in a misleading way can lead to a loss of trust if the investors or the public sectors or the public discover the discrepancies somewhere else later. And also for the second point is to the careful use of certain sustainability related jargon terminologies. To name a few, like actually we can see a lot of companies, they claim that they have the carbon offset project, they have the green product, they have a lot of eco labels. But actually some companies may claim that they have a carbon offset project, but the investors discover the project do not even meet some basic criteria of carbon offsets. So therefore, I think that the frequent misuse of these terms can lead to a misunderstanding and even the reputational damage in future. And for the public sector, I think the public authorities should implement certain mandatory disclosure requirements for both the quantitative and qualitative data on, for example, the carbon reduction projects. And this disclosure should cover the entire life cycle of a project from planning to implementation and results. And this ensures that the companies could provide consistent and comparable information. So it's really up for the interpretation of the investors, like no matter what kind of claim was actually made by the company itself, since I think it's evidence-based and no data is hiding. And also for the second point is to deter the company from falsifying or forging data. I think stringent penalties should be in place for those that caught tampering with or forging information. For example, I think the China CCER program, as I just read yesterday, it was launched earlier this year. It imposes the sanctions not only on the disclosure entities found guilty of data fraud, but also on the third-party technical service agencies involved in compiling the emission reports for these companies. So this could actually create a broader accountability networks and ensuring the higher standards of data integrity. It would also detain, like some other companies may also refrain from such practices, given the strong sanctions is in place. Thank you.
Yeah, excellent. Thank you, Ling Feng. I think, yes, clearly the public sector or policymakers in general have a big role to play, implementing ex-ante measures to support high quality data and ensure all the stakeholders have the same understanding of important concepts, common definitions, and also ex-post measures such as penalty systems for actors who are not behaving well. So thanks for sharing this. Now let me turn to Sayuri. Sayuri, the example of Malaysia is quite impressive. But a recent survey you conducted shows that many countries are not ready for climate-related disclosure and have a much less ambitious strategy. Can you share more details about it and how your joint project with ADB, Asian Development Bank, can help improving this situation?
So first of all, I think Malaysia is impressive because they try to also promote disclosure with regards to large unlisted companies and also small medium enterprises disclosure. That's very rare, even advanced country in Asia. So in that sense, it's great. But in Asia, I think biggest problem is how to improve the quality of GHG emission. Because GHG emission, unless the company calculate by themselves, basically they estimate based on activity data and emission factors. And many countries in Asia, they don't have a country-specific detail emission factors. So because of that, they have to use some data from US or UK or Japan, where data are more advanced. So this improving data infrastructure is most important thing Asia have to do. And so, and at the same time, promoting this disclosure and other issues. So recent survey we made, and then a lot of countries, they are aware of the TCFD and ISSB disclosure, but a lot of countries are not ready in terms of promoting company to disclose transition plan and climate scenario analysis target. Very, very slow. So, so we our project try to deal with central bank and financial regulator. Rather than companies, we like to promote their understanding, and then we don't want to leave some country left behind. So we try to give a lot of informal dialogue among this financial regulator to promote information exchange and a deeper understanding of each other's approach. And then we hope that we want to promote discussion in Asian context. So first important thing is that promoting GHG emission data and then ISSB disclosure, but ISSB disclosure is not enough because they don't really touch on the net emission target and decarbonization sector pathway. And as Ling mentioned, the carbon credit, carbon offset quality is a big issue, and then transition finance is another important framework. So we try to, in our project, we try to focus on these each specific issue at each round table and capacity building workshop. And also we try to provide a conceptual framework so that people can base on their mutual discussion. So this project just started last November, but I think we will do this fall. We will focus on transition finance and finance emission. So we will continue to do this and work with a financial regulator and central bank in Asia. Thank you.
Okay, thank you very much, Sayuri. And let me add that on the ADBI website, there is a web page on this project, the Climate Finance Dialogue. where a lot of resources are provided. So for those who are watching this webinar, they can find additional information on climate disclosure and all associated issues or concepts. So thank you very much. It's now time to close this episode. I want to sincerely thank our panelists for sharing knowledge as well as experiences so that policymakers can better understand how to set an adequate framework supporting ambitious corporate climate disclosure and direct investments where this will be the most impactful to respond to climate change. Before closing this session, let me share with you my key takeaways. In this webinar, we acknowledge that the response to climate change has to be public and private, and that to scale up private climate finance, climate-related information disclosure will play a critical role to direct resources where these funds can have the greatest impact. To support this agenda, the action from policymakers will be critical to set up gradually an adequate regulatory framework to support climate disclosure and sustainability reporting, which can then direct the investments where these are the most impactful. And at the same time, ensure that companies have enough time to adjust their processes and adapt their reporting requirements, reporting practices, sorry. We also saw during this webinar that creating a national consensus is important to ensure all stakeholders are on board and make sure the regulation is adequate to achieve the best outcome. Another point I would like to highlight is that with climate disclosure in line with international standards, corporates are also better prepared to face climate, physical, and transition risks. So I would say it's a sane process for companies to be better aware of new risks and mitigate these risks. And we said during the webinar that all of this is creating huge opportunities for companies to remain in the business game, if I may say so. But implementing high quality disclosure has a cost, and companies have to be supported through an ambitious and agile framework. Capacity building is also key. High quality data through, for example, the provision by public actors of emission factors can be very critical, especially to compute and prepare data on Scope 3 emissions. So these are some examples. And I would like to conclude by the fact that raising awareness on climate disclosure will continue to be an important challenge, and I'm happy to be part of it because ADB, the ADB Institute, and the Asian Development Bank are committed to support this agenda. So thank you for joining this 5th episode of the webinar series on the economics of climate change. The recording will be uploaded to the event webpage shortly. Please also take a few moments to complete our post-event survey. Have a wonderful day, and we will look forward to welcoming you to the following episodes and future ADBI events. See you soon.
Bye. Thank you.
Thank you.
Thank you very much.
Bye.
Everyone.